Hi and welcome to Swissquote Daily Market Talk. It's Tuesday, March 18th. The Fed starts its two-day meeting with a lot of uncertainties regarding the growth and inflation outlook for the US. The US equities are falling from grace while their European and Chinese peers attract global investors that are looking for opportunities in the thickening dust. So the US equities recovered yesterday for the second straight session after a 10% sell-off brought the S&P 500 to the limit of the correction zone last Thursday, remember. So the rebound was backed yesterday by the oversold conditions reached last week and also some mixed retail sales data that was released yesterday in the US, showing that the retail sales in America slowed in the month of February, but they did not collapse. Moreover, the control group sales, which excludes cars, gasoline, food prices, and building materials, because these categories are highly volatile and feed into the PCE and GDP numbers, rose 1%, reversing the 1% slump of the month before. As such, yesterday's retail sales data from the US came to temper the recession calls for the US economy due to the tariff chaos and somehow allowed a further rebound near the correction zone for the US equities. As such, the S&P 500 gained 0.64% yesterday and was up by more than 3% compared to its March dip at some point in the session. The Dow Jones Industrial Index advanced 0.85%, while the technology-heavy Nasdaq 100 underperformed its peers with a 0.55% recovery only as the Magnificent Seven stocks lost 1%. So the loss of momentum among the technology giants of the US and their high valuations continue to weigh on the investors' appetite as uncertainties loom and growth expectations wane. So in this context of waning growth expectations, yesterday may have been a relatively calm day for the equity markets around the world, but the OECD released its latest growth forecast and they did not look pretty. Because the OECD lowered its 2025-2026 growth forecast for most leading economies, except for China. And the predictions were actually lowered by a similar amount, a comparable amount for the European economies than the US economy. Mexico and Canada, on the other hand, suffered the biggest slump in growth projections at the OECD due to the tariff situation. And the OECD obviously pointed at the tariffs globally, the global trade restrictions, and uncertainties as the main cause of slower global growth outlook, and also warned of higher inflation and inflation expectations. So it's nothing that we did not know before, with the exception that the EU's military spending plans, interestingly, didn't look like they have been taken into account in the OECD's growth projections as much as they have been priced in by the investors since the start of this year. In fact, select Stocks Europe Aerospace and Defense ETF, for example, an ETF that's including names like BAE Systems, Rheinmetall, Rolls-Royce, and Airbus. Well, that ETF gained 46% since the beginning of the year, as these companies I just cited are expected to benefit big time from the huge government spending from the EU governments that the EU governments will be deploying to compensate the loss of military support from the United States. And remember, the German politicians will be voting today to pass a 500 billion spending bill on infrastructure and defense. And if that bill passes, it will make a big change regarding the European debt control measures and the austerity measures of the past decade. That is a big development, guys, for the European economies. It sure pushes the European yields higher these days, but the prospects of high government spending also improves the European growth expectations, mind you. Maybe not at the OECD just yet, but surely among investors out there. And the latter also continues to support the euro's appreciation against the US dollar, as the US yields, in contrast, remain under the pressure of waning growth expectations for the US economy. Plus, note that there's also a growing hope that the US efforts to broker a peace deal between Russia and Ukraine could be eventually successful, and that would be obviously a development that could restore trade relations with Russia and the EU, ease energy prices in Europe, and also support growth on the old continent. Trump and Putin will be speaking today. Also today, the Federal Reserve begins its two-day monetary policy meeting with soft but not collapsing employment and sales data, softer than expected but still near 3% inflation, and also a very high level, a high dose of global uncertainty and tariff-led volatility in its hands. That obviously threatened to slow the economic growth in the US while boosting inflation. As such, the Federal Reserve is expected to maintain its interest rates unchanged at this week's monetary policy meeting. The dot plot that's also going to be released this week, and Jerome Powell's press conference will be closely watched by investors on the other hand. Now note that economists predict 2 rate cuts for the remainder of the year from the Fed, while traders see 3 rate cuts. Some analysts also think that pausing the QT, so the quantitative tightening, could be an interesting move for the Federal Reserve for relaxing the financial conditions without touching the interest rates in the first place. Now, Powell, remember, had said in a recent press conference that the US economy remains on a solid footage, a prediction that is not necessarily shared by Atlanta Fed's GDP Now forecast that warns that the US economy could shrink by more than 2% in the first quarter of this year. As such, the US dollar index remains under pressure, the pressure of waning growth expectations. That is, quite hard to reverse, to be honest, because on one hand, a dovish Federal Reserve outlook would be supportive of a further dollar depreciation, and on the other hand, a conservative, a more hawkish Fed outlook would be, bad for the growth outlook for the US economy, and would also be supportive of a further dollar depreciation. So the only thing that could eventually boost the US dollar appetite is an explicit support from the Federal Reserve that it is ready to step in if the economic growth in the US is under a serious threat. Voila. So the euro dollar has actually a solid chance of clearing the 110 psychological resistance to the upside one day in the foreseeable future. The overbought conditions, however, could not lead to a sustainable attempt in the very short run. But the outlook for the euro dollar remains positive. Elsewhere, the Bank of Japan is also expected to maintain its own interest rates unchanged when they will be announcing their own monetary policy decision tomorrow. But the rise that we see in the Japanese yields have been accelerating along with the European peers since the start of this year. So, in the sense, the 10-year JGB yield stands near 1.50% today, while it was fluctuating around 20 and 60 basis points this time last year. And obviously, shorting the dollar against the yen has been a profitable trade so far this year. And although the rising borrowing costs in Japan and the stronger Japanese yen have been weighing on the Japanese stock valuations since the start of this year, Warren Buffett, the very Warren Buffett, announced to have increased his stake in 5 of Japan's leading names: Marubeni, Mitsui, Mitsubishi, Sumitomo, and Itochu. And while speaking of Warren Buffett and his darlings, another Warren Buffett darling, the Chinese EV maker BYD, Build Your Dreams, just revealed a new charging system capable of providing 470-kilometer capacity in just 5 minutes of charging. That's comfortably above what Tesla is capable of doing with the superchargers. The same thing would take around 35 minutes at a supercharger from Tesla. So BYD is trading near all-time high levels these days with a PE ratio of 32 only, compared to Tesla that's been in a free fall mode for a wide range of reasons, obviously going from Elon Musk, the rising competition, to tariff war, and that still has a PE ratio of around 108. Just saying. So this is all for today. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, on LinkedIn, and also on our new WhatsApp channel, Threads, Telegram, and Blue Sky for regular market updates. Subscribe to our YouTube channel for daily market comments. And please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow. And until then, good day trading.